Okay, good evening, gentlemen, ladies and gentlemen, and as people are, slowly drifting in, whoever can make it, this session will be recorded. This market update webinar will be recorded and uploaded to the Clueless 8 YouTube channel for others to view at their own time, hopefully before the market begins tomorrow morning. Today's the anniversary of the 8 years, always the number 8, of the 2009 market bottom anniversary. It was March 9th on 2009 when the SPX hit 666, and today we're sitting here at 2365 almost, after hitting 2400. Quite an accomplishment, say the least, in 8 years. So again, this is a Clueless 8 Trading market update webinar. This is Frank. Full disclosure, this is purely for financial education and not for any solicitation or advice. And as always, I thank all my members and for their continued support in keeping our service alive and vibrant. And I do want to go over a bunch of things which I thought would be of interest to all my traders and members, and that's the reason for doing this on a Thursday evening. So let me just, it looks like somebody else is coming in. Give me a quick second. I need to repost this. There we go. Looks like Fish Eyes is going to join us. He just got in. All right. So a couple of quick important facts. And let me start off by saying that it doesn't matter how professional and how disciplined and how effective I am in what I do. There are certain times in the market, and as a peak performance trader, and as a person who wants to basically try to get things to maximum results, I will tell you that this market, and at certain times, especially this afternoon, the monster reversal that we saw really took me by surprise. And that is not really heard too often because not many things really take me by surprise anymore, given the years I've spent in the market through good times and bad times, and certainly more good times that I have enjoyed, and God has blessed me to have the fortitude and the strength to do what I do. So saying all that, let me just say something a little bit humorous. Instead of hammering and doing my Clueless bootcamp coaching to my great members, here is a point that I need to do some bootcamp coaching to myself, which I always do. Like I jokingly like to tell people that they should slap themselves hard when they do stupid things. Well, I did something quite stupid today on one trade. Had a fantastic day, net positive, very nicely positive, but one simple trade which I'm going to illustrate for others to see the example that if somebody is not fast enough and somebody is not concentrating enough, that one trade can go terribly wrong within a matter of an hour. And again, I might win out on that tomorrow morning. Tomorrow, I have all day tomorrow to play that out, and I'll certainly be active in recovering that trade. But the bottom line is, I just want to show how dramatic these markets are and the power of these machines to turn things around from these tactical levels without even touching the levels that it should have gone to. And that would be the case with the SPX puts that I dove into on the drop in oil, which you're seeing on the third screen here, which was the collapse in oil, which was a three-stage collapse, but the one that hit the market at around 1 o'clock, and then again at 2 o'clock, the plunge, and every single indicator that I was looking at showed that we would have a movement down, not too much, but at least towards a level where I think there's certain gaps would be filled, and I showed that repeatedly. It didn't quite get there today. Okay, so what I'm getting at is that the speed and the ferocity of how fast the markets move, and you put in a trade, and I think I went in a little bit harder than I should. Again, I might be rewarded tomorrow. We don't know yet heavily, but the fact is, that obviously cost me a few pennies on that particular one trade, which was the 2350 SPX March 10th, 2350 is expiring tomorrow. Bought them at about 3.5 or so. They closed at around $1.60. So yeah, a little bit less, more than 50%, but it hurt. So the bottom line is that let me just show you guys what exactly is going on. Now I put static charts all the time, and I know a lot of you are, all of you are reading it quite well, and at least trying to understand it. So let's take a look at first and foremost on what diving into the technicals a bit. These charts are really drawn to precision. Here you have a 4-hour chart that mimics as closely as possible the daily time frame on the markets, and for traders who are actively trading, both swing and day trading, or overnight holds, these 4-hour charts and the 1-hour charts and the 15-minute charts are extremely, extremely critical. You all know that by now. So let's take a look at this, and I'm going to make this screen, and then I'm going to go screen by screen on each. And I will show you two things here today, which really is a little bit perplexing to me. But then technicals are not meant to be perfect. There are animal spirits in the market, and regardless of how accurate my technicals are, and my tactical, as I like to call it, trading points are, the animal spirits sometimes take over, such as this afternoon. So saying all that, I have been, if you look at my charts from yesterday, my comments that I posted earlier on showed you that showed you a bunch of things showing that we are getting close to a possible tradable bottom, okay, as we enter next week. We'll talk about that in a second. So first of all, here is a 4-hour chart here, drawn to precision. You have a wide channel that the market was traveling in all the way going back to the beginning of February. That's where this channel is coming from. All right. And you can clearly see here, these are wide channels. You know, the depth of the channel is roughly, here is 2347, 2378. You're talking about 30 points. That's roughly about 180 Dow points. You know, not a easy channel to really navigate, and we have been doing it very well with an upside bias, as I've shown you all repeatedly. And my bias is still somewhat on the upside to a certain degree, which I'm going to talk about today, and I've explained repeatedly on my charts for the past week or so, and also in my last video cast where I called it the topping process. We are going through a topping process, period. Okay, we are also coming into the middle of the month, which is a turbulent time, and we shall see. So the channel here, the width of this channel is roughly 30 S&P points, and that's I'm sorry, let me see. Yeah, 30 S&P points, and that's roughly about 150 to 180 Dow points. So intraday, when we get these type of, intraday, we get everything. We get a bull market and a bear market all within the span of the market hours. Between 9:30 and 4:30, basically the 7 hours that the market's open, we actually get a bull and bear market right there, and that's called tactical volatility. So when people and traders, and I warn you all, think that this is a straight line up or down, the market's just going to trend down and it's going to trend up. Well, it doesn't work like that. And that's the reason why we have to shift positions pretty dramatically at certain times, depending on the levels that I'm pinpointing where the markets would bounce or not bounce. Okay? So it's pretty clear about that. But as humans, I'll tell you that a lot of you are still not quite understanding the grasp of that, even though you've gone through it, I would say, thousands of times over the past couple of years. But the brain always likes to think in simple ways, like, hey, is the market going up? Is the market going down? Now, on a longer term frame, you could see that, but in a shorter term frame, the volatility algos are extremely active, and right when you think it's going to be, down and over with, the market turns around. Case in point, this afternoon, approximately 1 p.m. right there. Okay, looking at my other algo charts on my other screen, it was approximately 2 p.m. when we had that big reversal hammer right here. This was actually 2 p.m. and this is where we are right now. Futures are up roughly 5 points, and we basically took in from 2354 on the E-minis. On the S&P 500, we hit a low of 2354, and in this case, it was also showing 2354 on the E-minis. I'm not quite sure why. The S&P 500 low was showing 2354. It should be a slight difference on there by a couple of points. But anyway, from this 2354 level, you get a very sharp reversal hammer. Okay, and I didn't react to it fast enough, and I went with my gut, said, hey, I have all those profits from all those multiple trades that we did over the past 24 hours, over the past 48 hours, multiple winners on multiple fronts, whether it be the Regenerons, whether it be the Amazons, whether it be the Teslas off the top, whether it be Priceline, you name it, SPX calls, all kinds of stuff. So I said, okay, let me go in there. Goldman Sachs, Chipotle, quite a few powerful movers. So saying all that, let's go back to this channel here. So this channel measures about 180 Dow points, a wide one to say the least. Okay, and 150 or 180 Dow points. So we moved down on this consolidation channel that I've been showing, and these are what these lines are. Forget this line for a minute here. This is a megaphone pattern. In case of a real breakdown, you're looking at the market dropping to roughly 2,300, which I think will happen in the month of April, in my opinion, and that is the target, a measured target. So this framework that you're looking at, and you'll see a lot of you have seen me drawn these megaphone patterns, are extremely accurate, except they're slower moving. They don't happen in 1 day or 2 days. They take maybe a week or so. And so this megaphone pattern that you're looking at, this is the megaphone, on the downside measures down to 2,300. But that's a later days, story, not right now. So saying all that, here's the channel that is the consolidation channel, and it looks like we're breaking out of the consolidation channel based on the monster hammer reversal that was initiated by the machines at around 2 p.m. today, after the oil plunge, which we'll cover in a few minutes. So saying all that, at this point in time, this has been a position, and these are where the lines are drawn. Remember, these lines are not drawn just because I like them drawing at that point. These are the supply points where most of the selling or the buying basically ceased, or that's called resistance, right? So the resistance here remains at around the 2373 level, and that's where we reversed on a Wednesday morning. Wow, seems like a long time ago. It was just yesterday. And then we have a big fat sell candle, a sideways move, and then you can see what's going on. So so at this point, if we break above the 2373 level, I've been showing the upper end of this where the last rejection point came in, which was around 2383. So that translates into around 2385 or so on the algo charts, which I think all of you should review every single morning and every single day, multiple times when I post. And I know a lot of you are full-time, you have full-time jobs, and so do that and focus a little bit more. Take 15 minutes off at the end of the day to look at them, because they really make you a smarter trader. And you start to see the same stuff that I look at and how my brain processes the information. It's like art. The more you see art, fine art, for example, you go to the Metropolitan Museum of Art, you go to museums in your city, the more you see it, these things become more, it's called a second nature to you. The same thing is charts and me. So the bottom line is that the level on the SPX that I constantly keep on showing is basically the point where there's multiple rejections that have happened, which is approximately 2378, which was the last major inverted hammer, known as basically the opposite of this type of stuff, and that was and that happened on very suddenly happened on the 6th, which was a couple of days ago, and Monday, right? 6th was Monday, yeah. Monday at around right off the bat, right around 3 p.m. or so, and there was a gap down and we slid down. So anyway, so the bulls would say that, hey, we broke out of this consolidation channel. Now we're going to basically rip up, and let me just get my drawing tool, and then we're going to basically move higher and attack the zone, which is approximately around 2390 on the S&P I mean 23.90 on the E-minis, which is roughly around 23.95 on the very close to the highs. And this pattern will be completed. Very, very possible that happens. Is it possible that happens in one single day? Who knows? We have had 300-point up days. We could get there real fast, and I'll switch directions, take my losses. Pro traders do that. All traders should do that. If they feel that, hey, that's a lost cause, it's not going to happen right now, why sit through it? Get out of it, make money elsewhere. That's what we do. That's what I know all of you try to do, and just have to be quicker and faster. Just because you lose money in one trade, got to have a commitment and mental strength to make it back up in a couple of other trades, or maybe one big trade on something else. It's just the way it is. You can't sit around, because otherwise those losses eat into your head, and you really can't. You're kind of immobilized, and your mental frame is is kind of stuck in the mud. Getting stuck in the mud as a trader is the worst thing anyone can do. It's the same thing in life. So bottom line is that this pattern, gets completed, and that would be the bullish scenario that would be, that needs to play out for the bulls. Okay, and that's a pretty large move, because if we break out of here and go and get up here, and this was the last point where we really sold off hard, so you're looking at around, above 23.94, close to kissing distance of the 24.01. And in the case of the S&P 500, the high was, all-time high was 2,400. I'm not quite sure why the E-minis are showing the same numbers as S&P, but hey, I'll take it. So 2,400.98 is the printed closing high on the SPX. So right around there. If we break out above that, then we're looking at the upper end of the channel, because this is a channel, which I consider to be a pretty dramatic high for this leg of the move. Not that other things can happen that we can't break out, but I'm just giving you, as a very disciplined trader, I cannot project crazy bullishness, and I certainly cannot project crazy bearishness, right? So at this point, tactical bullishness would say that we are getting to the up, and that the max move would be 24.20. That's a pretty significant move from where we are here. Okay, you're talking about, let's see, 32 plus 20, you're talking 52 S&P points. That's roughly another 300 points on the Dow. Is it possible? Absolutely, absolutely. So saying all that, the first point that I want to make is that we have to take out this zone here. And once this zone is taken out, then we have this pattern symmetry getting played right here. Okay, that's one point. The second point is that there are certain gaps that need to get filled. We got close to it, but we didn't quite fill it, and for that you would have to basically focus a little bit more, and I know many of you did, to this chart, and I'm just dragging it in from the other side. Bear with me. And the more you study these things, the more sense it makes, just like anything else. Okay, so that's why I keep on pushing all my members. I do care about how you guys do and how you guys learn and how you profit. Nothing makes me more happier than when a lot of people participate on a certain trade that does well for us. And that's why I kind of push you guys to do what is necessary to be done. So this is the Friday up and down scenario. So this is where we are right now. After hours, we're pretty much here after hours. We moved up a little bit. Keep in mind that at the market close, this downtrend channel, these dotted red lines, was still intact. We were kissing the pivot, and I think we went up slightly above the pivot, given the fact that after hours futures are up about 5.25 points. So we're somewhere in this zone here. However, first thing visually that you see is that downtrend is still intact. So the two possible scenarios that I see happening is the market initially drops, which I think would be fantastic. Kind of talking my own book, it means that I get a, what do you call it, a stick save on the puts, and come out profitably. Or the market goes sharply higher And of course, it doesn't go immediately like this. It can. Um, and this is the algo HFT version of the same chart that I was showing you behind this behind this screen on the Thinkorswim platform. So so these are two scenarios. Sharp move down. Now, it doesn't mean it has to come all the way down, but there's a gap here. That's why this red line's drawn, and that's why I write the word gap fill for the untrained eyes who don't quite see that there's a gap here. Okay, so this gap almost got filled because it came into the gap, or close to it, the upper gap. It's right there, and there's a lower gap. Remember, there's always an upper gap and a lower gap, but the upper gap got filled, got it, sort of kissed it right there before the reversal hammer started, but the lower gap never did. Now, as a strict technician, we would like to believe that the lower gap does need to get filled before the market basically makes a definitive tradable low, which is very profitable, right? When we get a tradable low, we can basically jam hard, and it doesn't matter if it's a day, it's a couple of hours, we make some real good money on the upside. But it didn't get filled, and gaps always get filled. But never know. One of my theories is, and do listen to this carefully, is that one of my theories is that that everybody might have, I mean, the hardcore technical guys and the machines were looking at the same thing. And like they say, the watch pot doesn't boil. Well, guess what? That's probably what happened. It got close, didn't quite get there. So does it remain the unfilled gap? Yes, technically it does, but we don't know. Because this move down here, the 2350, would have been very lucrative for the 2350 alert that I gave on the SPX puts, expiring tomorrow. Now, they were cheap. They were $3 and change. It's not like I alerted something that's $7, $8. But if it hit that 2350, now there's very little time value left. It's all intrinsic value. In other words, the options are moving point by point on how the markets are moving. So a quick drop towards the 2350 would have catapulted those puts into green territory. But the reversal hammer, for now, messed up that particular trade. So saying all that, these are, when you look at them carefully and forget about how complex it looks or whatever, it's quite simple. You have an upside channel that got broken, right? And there's a downside channel, which are the red dotted lines. The other lines in there, for a lot of people who are getting new to my service or going to be listening to this, you have the yellow line here, very critical. That's the pivot. Remember, above pivot, machines buy. Below pivot, they sell. Pivots are big resistances. How many times have we seen, and remember, the pivots are not static. They are calibrated every single morning to the levels that the market closed at the day before. So the pivots are shifting. The pivots will be higher. If the market was higher, they'll be lower if the markets are going lower. So, but during the day, they don't shift. They basically are calibrated first part of the morning. That's why it's so important for all of you to take a good look at my pre-market charts, because they help you a lot in your effective trade management during the day. So how many times have we seen these candles get to the pivot and then immediately start selling off, or find big resistance, maybe go up a little bit, and then, why is it dark? Hold on one second. Kind of move up, fake breakout. Remember, all the lines are pointing down. The 50 SMA, the 34 SMA, the yellow line, which is the 5 SMA, they're all pointing down. So the downtrend is still intact. In fact, the downtrend is not broken unless we take out 2385, around that level. This gap up here. Once this gap is taken out, that's when one can convincingly say the downtrend is broken and we are back to going back and retesting the 2400 level. But till then, the minor moves that you see are simply algorithmic robotic moves. Either it's a fake out or it's a fake breakout or whatever it is. The other reason why maybe this gap didn't get filled is because there are way too many shorts in the market. There are way too many hedge funds who, despite the fact that the market's been on a severe uptrend, are still shorting the market. So when institutional shorts need to get blasted out, the machines will go the other way. And that is the simple reason. So despite the fact that the oil collapsed like nobody's business, I mean, that was serious drop down. You would think that we would get some severe margin sellouts, which we did. That's why we were down 67 points at one point, right, this afternoon. But then they soaked it up and ran with it. However, it did happen on very light volume, and certain major indicators didn't change, which I'm going to show you. So the bottom line is this downtrend doesn't get broken out till we actually break out of this cup here. That's a trend change. And I'll be certainly keeping an eye on that. I won't be waiting around for here. I mean, if we break out over this Bollinger, over this green line here, then I know things are starting to turn. We might get that the first part of the morning, for all I know. So scenarios that I drew out can't be any simpler than that. Either we go higher, and this white box here is basically the gap. Remember, there's a gap here, upper gap, there's a lower gap, then there is another gap here, another gap here. So this gap, that's why I have a box here, right? That was the gap fill. This upper gap and lower gap all got filled. Remember, there's another upper gap here because it's been extremely volatile market, right? We're gapping up and gapping down. So, and this gap hasn't, this gap was filled here, but the upper gap hasn't been filled. So that's why I also have this second scenario, which I've been posting for the last couple of days, that we can get up to approximately 2380, 2385 real fast. This type of move. So that's it. So that's your quick read on the algo charts for some of you who are still not getting it. Look at the state of the slow stochastics, which always gives us a nice, strong triggered signal. It's kind of limping down here, not breaking down, but I wouldn't consider this strength. I consider this strength, big triggers, right? When you turn around like that, sharp move up, sharp crossover, those I buy very heavy. You guys all know that, and many of you follow me on that. Big moves, even though it could be sharp like this, or it could be monstrous like this. Well, the monster was basically last Thursday, right? Or last Tuesday, when we broke out like crazy, and now we are basically given back. And I did cover this on my previous video cast, the last one, that we would at least come down and try to test that breakout level. I guess we already did that, and we went below that, and we came back and stopped exactly where we broke out from. Isn't that interesting? And the reasons behind that, I also mentioned that clearly in my past video cast, why these things happen, where the market makers have to basically adjust their books and come out even. So this impulse surge of the huge 300 some point move was all pretty much given back over the past couple of days. I hope that's clear with everyone. So so the thing is that there's nothing much to say. This is not necessarily this is kind of like dwindling around the kind of hopping around the bottom of the riverbed, right? I never got a real signal to say buy. This was a real signal to say buy, but I was looking at a couple of other things which didn't change, and I didn't jump on it, even though I did have the cheap 2370 calls that I sold for 65%, but not enough. Let's just put it this way. All right, so let's move on. So I hope that.
Hey, Frank.
Go ahead.
Hey, Frank, can I ask you one quick question?
Yeah.
I was noticing that ES, the index and SPX are about the same now. They used to be about 7 points.
I already explained that to you. I don't know why. You know, I just covered that last couple of minutes. I don't know why. Yeah, I agree with you. I don't know why they normally have 5-6 points off, with SPX is 5-6 points higher than where they are. But I really can't tell you on that because yeah. So I'm not going to waste time on that. I don't know why it is like that. And I just mentioned that. So this is where we are. And I highly recommend, not just recommend, it's almost mandatory that many of you who are Thinkorswim users especially should mimic this chart on your screens, because this is the ultimate roadmap for active traders. Okay, bar none. And the way I set it up, I'm looking at a 4-hour here, which is more of a longer term. You can look at it on a 1-hour basis, and you can clearly see here that what I'm talking about, this never, I shorted here when this was blood red. It kept on going down, and right here, from nowhere, it decided to reverse. So that's what I'm saying, that when these machines do what they want to do, they just do it. And then the stops get triggered on the upside, and bang, 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 the shorts start covering, and then you get a sharp reversal like that. So now this little gap here towards that 2375 level on the E-minis could very well get filled by tomorrow morning. And then we shall see what happens, whether we can break into this zone here, which would be pretty substantial, right? So this would have been extremely profitable when we shorted here, okay? But and this was pretty logical that it would come back and test 2350, because that would be, in my opinion, a very powerful buying opportunity. But some people might say that if we hit 2350, we could possibly slip towards the lower end of the channel. Remember, this is a downtrend channel. It's very well defined. That lower end, if we slip through 2350, there could have been an overshoot from 2345, and we could have something like this. Then we could have a big reversal hammer, except we had it from midair. Can't explain why these things happen, but I've seen it happen. And I didn't react fast enough on that one particular trade. But let's see what happens tomorrow. So saying all that, this is a major pivotal level of what I consider to be major support. And it slipped through to 2345. It's fine, because it's still going to recapture 2350 back. Right. So just wanted to show that very clearly. Let me just show you what else happened on the side, which I think is extremely important and telling me that maybe the 2350 does get filled tomorrow. If you look at the VIX, you don't have to be a rocket scientist or a real technical genius here. And I didn't even draw any lines on it, just showing it the way it is. This doesn't look like a weak chart. This looks like a very large cup and double bottom cup and handle type of thing, where it's going towards 13, roughly towards 13 bucks, like a pair of sunglasses, okay? With support right here at around 11. The market rallied powerfully for about an hour and a half. Yet when you look at the VIX, and that's why I put it out there was really no damage whatsoever. That's a little mind-boggling for me, because you would expect to see the VIX have a reversal hammer, something like this in red, right? But it didn't do that. The best you could get was a tiny little reversal candle. So the whoever the so-called smart money is didn't let go. They said, yeah, let them run up the market and run the shorts for an hour or so. But this, if somebody's really doing some hardcore reading underneath the surface, the VIX is still telling me it wants to go to roughly 13, which has been a powerful resistance where the VIX has pulled back from. So this probably gets, another scenario gets done. That means we will get that drop to SPX 2350, and it's going to happen rather quickly. Now, a lot of this can happen pre-market, right after the jobs number comes out at 8:30. Right? 8:30. All this can happen between 8:30 and 9:30. It doesn't have to happen during the market. We shall see. I want you to understand that all these resets and stuff happen when unless you're a futures trader, you can't do much about it. So that's the picture of the VIX on the hourly. Let's take a look at the daily. If I was more on the bearish bend, and one must have an open mind, because we can't be just like all rah, 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 or off to the moon type of thing. We have to be disciplined. And discipline is hard, Discipline is hard, because that means sometimes you sacrifice profits to be disciplined. But then you're right, really right. When you look at the picture of the VIX here, you can clearly see that it is forming a very nice bottom. And one of these days, and it's probably going to be, could be the middle of the month, give or take the couple of days from the 15th. The moon cycle's not too good either. I looked up when I was walking my dogs earlier on. My good friend Fish Eyes knows about that stuff. Okay. We're past the half moon now. In fact, the moon shape is weird. I don't want to get into it, but this lunar things do have an effect on the market. And so the VIX can have a big sharp move like that. And these type of moves generally are basically the 300 to 400 point type of, down days. Down type of weeks or more. I don't expect, I really can't read the VIX. VIX, remember, is not like a normal chart of a stock. It's a derivative, so it moves like a cardiogram, right? Electrocardiogram, EKG. So this is what it's doing. Bottom line is, when I look at this, it's not telling me that it wants to crash and burn and go to 9. Anything can happen, but I'm telling you the reality of what the VIX is stuck at 11, and every time it goes to 11, it moves up and goes to about, the max it goes to is around 14, and then it pulls back. If the VIX jumps up to 14, that means we're going to drop about 150 to 200 points on the Dow real fast. Real fast. And that means we would be at the bottom of this channel. Okay? Or maybe a little bit lower. But that would be the case. So looking at the VIX here, end of the day as well as daily, there was no sign of weakness. Got to keep that in mind. Let's take a look at oil. So bottom line, this is what happened with the oil thing. I'm going to go on the 15-minute. And remember, I'm a professional trader. I have multiple screens, but I can't watch everything at the same time. I switch back and forth a lot of the times. But this is really what happened. If I was watching this carefully, then I would have covered my short right away instead of leaving it open as it is right now. So what we saw was a very sharp drop which started at around, one second. So this one started right in the morning, 9:15, right? And then this one, and then you had another one at around 1 o'clock, this one. Now these, if you notice, are very robotic. Look at the size of the candles. They're like very systematic. That's because these are completely run by machines. And at this point, it is looking like it's created a somewhat of a dragon bullish pattern. We don't know yet, but at least for here, it looks like a dragon bullish pattern. There are many ones, but then it dropped really hard, creating another one, and now we're basically kind of moving sideways. Is it possible that it creates another one like that? Absolutely. Remember, the oil complex is heavy with large billion-plus-dollar bets, million-plus-dollar bets on the oil complex. They don't get erased in one day. A lot of these hedge funds are getting squeezed. They're getting their institutional margin sellouts. They got to sell in order to come, if they can't come up with the margin. They're all very leveraged. Remember, hedge funds are leveraged 6 to 1. That means for every $1, they're borrowing $5 more. And they could be, or 6 times leverage means they can borrow 6 times more, or sometimes they're 10 to 1. In the old days, they used to be 30 to 1. That means for every $1, they could borrow up to $30. Great stuff, huh? So the bottom line is, when the bet goes the wrong way, all hell breaks loose. You got to get out of your position, take the loss, bite the bullet. When you're that much leveraged, because our leverage margin is what, 2 to 1, right? For every $1 you can borrow $2 if you have a marginable account. In the case of hedge funds, it's a different story. So the bottom line is that when you look at oil, it's possible that it created a bottom at 48. Very possible. Is it possible that it comes down and retests this once more? Very, very likely. If the 48 level holds, oil is obviously going to bounce, and the next level is going to be around 51. That will push the market up towards that 2385 SPX level. That means we are back towards 21,000 plus. Am I clear on that? So that is, oil is literally at this point controlling the market because of the heavy-duty margin calls and such that are going in and out of the complex right now. So that's the picture with oil. Now let's take a look at couple of things here that I noticed which telling me that the sell-off ain't over. So one of the ones that I look at, and I've shared this private chart, I should say, with many of you, well, all of you to a certain degree, is the swing 533. Quick, fast look tells me this hasn't turned yet. Yes, it's flattening, but it hasn't turned. The best buying opportunities are when, or the signals are when it turns and it does this, and it does this. Okay? It didn't do it yet. Maybe you'll do it tomorrow. Once you get that turn, you start to see this oversold condition, which is starting to get alleviated, move up, and you could get overbought within 2 hours or 2 days. Once you get overbought, now this was a big move, right? This was that big wave 5 that we saw, or wave 3, whatever the case may be. And you stayed overbought for weeks and weeks and weeks. All through February, you stayed overbought. And then you had a quick reset on a minor drop like this. And then you got that big surge last week, which many technicians, some really smart ones that I read, have called a blow-off top. A blow-off top means the market cannot climb higher than that, or if it climbs a little bit higher than that, it will create a double top. If it's a double top, there are two ways to play it. Remember, nothing goes in a straight line down, case in point today, or other days when the market pulls back, then it heaves up. But you can do a swing short a month out, not a weekly once, maybe a month out, or a couple of weeks out, and just sit there on the indices. Now, the danger is that when you get these surges, like we saw these volatility surges higher, then let's say you paid $9 for it, then you could see it down to 6. But eventually, as the market winds down, after maybe making another attempt, and then slowly kind of does this, and then winds down and comes down towards the 2300 level, which I believe is almost a certainty will happen, then those $9 things will be up a lot. It could be up to 30. Those are pretty substantial gains, right? So, or it could be up more. Now, that's one way to do it. The other way to do it is basically manage your trades on an intraday basis and not really carry anything heavy overnight, because you just don't know whether the market's going to pop open 100 points, blast you out if you're short, and then go down again, and you wonder why you got blasted out. That is the nature of volatility. There's nothing you can do to stop it. So different ways to play this. A lot of big guys, they short the market and they go away for 3 months. If you have the luxury of doing that, fantastic. You can watch the market, but don't touch that position. Let it play out over a couple of weeks. Because a lot of these fund managers said, oh, I don't care about the short-term volatility and stuff. They're right. They are holding something, and they have all the money at their disposal, so they keep on just letting it ride, up or down. Remember, the biggest shorts in the world take months. Months. Okay? Biggest longs are the same way. If one can afford that, certainly do it. Buy some long dated, they're more expensive, and just sit on it and then trade intraday with the rest of the stuff. But you need quite a bit of money to have a substantial short position put away for a couple of months. But it is very doable because April's coming, and April's going to be, I don't know exactly when, because the markets are so powerful and choppy, but at least by the middle of April, we get a substantial drop, or prior to that. Because if everyone thinks we're going to get a drop by middle of April, the market won't do it. Just want to be clear about that. So going back to the swing 533, yes, this turn, so that's a mild positive, but nothing happened here. So from a swing standpoint, nothing changed. And here is another thing that I noticed. When you get the bars going red, okay, it tends to have at least 5 bars down. Standard procedure. Okay, from a substantial top. If this is a blowout top, we get a minimum of 5 histogram I mean, 5 histograms down on the MACD. Look, 1, 2, 3, 4, 5. And then the 6th one starts to go higher. So here we had the dome thing going on, which again, this was weird why this happened, but then that was all rigged, and then they just jumped it up. You got 1, 2, 3, and they didn't get that deep. These are pretty deep bars. What is the MACD histogram telling you? The MACD histogram is telling you that the buying pressure and the breadth of the market is weakening. Okay? Is everyone clear on that? Yes?
Yes.
Okay, good. So I'm just trying to cover some of these things that go through my head so you guys will understand. So the breadth of the market is weakening. Not a good sign. Not a bad sign, because the market can rise on light volume. No breadth needed. And again, the other thing that happened, and I've been talking about this, is this gap here got filled. And it basically closed within the gap. By a hair, but that's what it did, this little reversal hammer. But looking at this here, I didn't find any reason to basically close out my short. Let's take a look at the weekly. This is the weekly swing 533, something we don't really look at that often. The weekly sign is giving us a rather ominous picture of a substantial drop. And substantial in this type of market, you're talking 400 points, maybe 500 points, It is resting on the 50 RSI, resting on the 50 RSI, and the buy points generally are on the weekly when it goes to and touches the lower end of the RSI, which is 30. Just standard RSI stuff. Buy below 30, sell above 70 or 80, right? That's traditional RSI stuff. So looking at this here, it's right at the 50 mark right now. Look at the drop here. That's a little worrisome. Generally speaking, when a trend starts on a drop, it just doesn't stop after 2 weeks. And then all of a sudden just goes up. It can. What if oil jumps 10 bucks? What if the Saudis come out and say, yes, we are doing the output cut? What if a report comes out showing our inventories are depleting instead of increasing? It could drive the oil majors, ExxonMobil, ConocoPhillips, you name it, way higher. That's good enough for the market to rally another couple of 100 points. So I'm just giving you both scenarios that can happen. Now this is the first week down, and we have a negative crossover on the stochastics. So that tells me that if I draw a basic channel, that we're looking at roughly around that 2340 level or so, or towards 2340, 2330 as the lower end of the channel. There's nothing wrong with this. It's all healthy. Look at that. I used to call it the galloping horse pattern. It's basically a bull, it's not a bull flag, it's a consolidation channel. The weekly consolidation channel measures down to about 2320, which is roughly 40 points from here. You're talking about 200 points. And we are sold off for the weekly. And we could possibly be down here, and right there, you buy pretty hard. So that's another one. So nothing that the daily is telling me that it still wants to go down unless we have a 150 point type of move. Then what's going to happen is just show this to you again. Then what's going to happen is this will turn very sharply, and that's again a buy signal. And then we're going to go back, retest the highs. Who knows? We can overshoot. And this is going to get overbought real fast. We shall see. And we're certainly not going to miss that type of move. If I see this crossover, I'm going out there showing it to you all, and you guys decide what you want to do. The other chart that I noticed today is basically the Dow Jones Industrial Average. One second. And a very simple chart showing you the MACD, the slow stochastic on a weekly basis. Bear with me. And both of them are signaling weakness. Yes, it's a consolidation flag. We hit this dotted line is basically the middle Bollinger, which is very good. And this certainly looks like a consolidation flag. And I've shown that before. And consolidation flags in a bull market tend to break out. So that's a pretty high probability trade. But look what's going on here. And the last time it went down, it's not that we crashed, but we chopped around for quite a few weeks. But here we're much higher. So if we're not going to chop around here, either we're going to break out and go to the upper Bollinger, that means making a new high or retesting the highs, or we're going to fall. And 20,246, the one that you're looking down here, would be a screaming buying opportunity, because this will be deeply oversold at that point. The slow stochastics, you can see that slow stow, that will be, it'll be down here like it was here. And the last time it went here was right during the elections, which obviously was a phenomenal, in many cases, lifetime opportunity to buy the market. Seriously. I mean, we went from below 18,000 to 21,000 in a matter of 1, 2, 3, 4 months. That's history. You guys all know that. So I don't expect the market to go up another 4,000 in another 4 months. I mean, there has to be a limit somewhere, right? But who knows? Like I said, if all of a sudden the oil stocks all wake up, all the biotechs keep on continuing their rally, you could just pump up the market big time. Anyway, this is negative. You can start to see the lowering, but just because it crosses down doesn't mean it's a crash. It simply means it's just letting out some hot air. And this is where we are. The resets are coming. It could be slow, and then all of a sudden it'll just drop 1 or 2 days, rise, and I think those big drops are coming in April. Here is the one which really boggled my mind today, all right, because this is the NYMO, the New York Stock Exchange McConnell Oscillator. Hey, look, we had a pretty powerful reversal. Do you see any reversal here? I don't, and that is weird. I would have thought we are deeply oversold. 88 generally, minus 88. The last time it was during the elections, we were minus 75. I showed this chart pre-market today, except this is the updated one as of the close tonight. I mean, what the heck is going on? Maybe it's just oil, which I think the energy sector is what, 20% of the S&P? But wow, we're at minus 88? In one hand, that's a screaming buying opportunity. I mean, that's like saying, holy cow, we're just going to buy with hands down. Could be. But nothing changed. It's still pointing down at the close. No change here on the MACD, which is plunging. The histograms are expanding. It's at minus 19. It's pretty extreme oversold conditions. And the full stow is at 0. It can't go any lower. Remember, stows can't go -1, right? McClellan oscillators can, but not stows. It's 0, 20, 50, 80, and higher than 80, 90, whatever. So the bottom line is that I would have liked to see a turn, saying that the market has put in some sort of tradable bottom. So one way to interpret it, we are bottoming, but there's a little bit more downside left. That's the only way I can see it. But aside from that, we took out support 1, support 2, and we went below the level of November 2016. Pretty wild stuff, okay? It could be that the heavy-duty oils basically had an overweighting on the New York Stock Exchange, obviously, so it basically, collapsed with it. Let's type the NASDAQ in there just by changing the symbol, NAMO. And on your own, do take a look at this. It's on stock charts. So the NAMO is also the same story, which I find to be weird because NASDAQ overall, I know some chip stock that we don't cover and we don't look at, we're getting clobbered today. But look at the NASDAQ McClellan oscillator. That's also getting into severe oversold territory. But we are starting to see a minor turn here. Okay, this is like really tea leaf reading. So, reading the tea leaves. It's not at S2 yet, but it's at minus 53. During the elections, it was minus 75. So we do have another room to move to S2, support 2 at 63.04. But the time where you want to buy with some level of real confidence for swing trades is when you start to see this shaded area, which is the area for the McClellan oscillator. You can show it as a bar. You can show it as a line. It's better easier. I've always looked at it through, to the areas when it's starting to turn. When it's starting to turn, you can put in a nice swing trade and just sit there for a couple of days till it starts to get overbought again. Now notice one thing here. After the big surge on the oscillators, okay, which I called very correctly right after the election. Remember what I said, right? And a lot of new members should listen to that video cast. I said once we turn, and after the third day I said, guys, this is going to be Brexit on steroids. The move in the US markets. And boy, was it Brexit on steroids mixed in with some nice cocktails. Okay? Because that's exactly what happened. That's why we went to 2400. Well, that's what Brexit on steroids looked like. And the reason I said Brexit on steroids, because on June 27th, we had also turned after Brexit, but not a 3,000 point plus move on the Dow. We had a 2,000 point move or somewhere around that. So bottom line is that this was the elections. But since then, it's kind of petering out. We should be, look, the market wasn't at its highs here. The market wasn't at 2,400 in November. The market's at 2,400, yet if you look at the McClellan oscillator, it barely went to 36. So in other words, there is a diffusion or deceleration of energy, weakening of energy in the markets. Less participation, few stocks carrying the market higher, all kinds of stuff that you guys read about other places. This has not turned yet. Once it crosses over like this, you buy. This is still pointing down, telling us that there's more downside coming. So these are the things that I wanted to show you guys, and a couple of good pieces of suggestion that I can tell you. Futures are up 7, by the way. So let's take a look at this screen, bingo, and see what exactly, and oil's creeping up a bit too. And of course, the immediate reaction as the global markets open, they're going to take up on our powerful rally that we got first part of the morning. I mean, sorry, late afternoon. So they're going to play, that's how global markets work. They're going to go with that momentum. So looking at this here and zooming in, basically it wants to go right here to 2372. So by the time, let's say midnight arrives at 1 o'clock in the morning, we should be up 10 S&P points, mark my words. And by that time, on the 1 hour, we are going to be, again, back. Look what's going on. Back in severe overbought territory. And all that can reverse rather quickly remember, you don't buy markets up 10, 15 points. You let it rest a little bit, then you run into it. So if you're long SPX calls, then you want to sell it right at the open, see for any pullback, and jump in again. Period. So, but this is getting severe overbought. Let's take a look at the 4 hour. And the 4 hour is telling us, remember, this is the closest thing to a daily. It's getting up there. By the time we are up here, S&P futures up, let's say 11 or 12, we'll be in this zone. And once you get into this zone, you don't want to aggressively go long. Not to say that the market can't open up 15, pull back 3 points, and then run up another 30 points. It's done that before. Did that last week. but this is what it's doing right now, because I'm noticing the futures are up 6.5 points. Anyway, couple of important things that I wanted to mention to you guys, which I think would be helpful. Number one, let's take it. Let me show you a picture of the SPX, which I had drawn a beautiful chart yesterday, and I hope that everyone saw it. And if they didn't, it's their fault. I mean, it's their loss, not mine, because this is I constructed this chart. I looked at it. You know, some of my work I like better than I like the other ones. Here, I didn't have to do too much thing, and you can see this. Great. So here you have a consolidation channel. It's almost picture perfect that it hit the bottom of the, well, didn't quite hit. I mean, that's the reason I kept on saying, let's go to 2350. It didn't quite hit this, see? Because the real hit would be 2348, 2347. And remember, this is the SPX, no E-minis, nothing. This is the standard SPX. Here's your consolidation channel bull flag. Here was your trading range breakout, right? 2304, 2250. 9 out of 10 times over a period of weeks, you come down generally, and you've guys seen this happen way too many times. You basically do retest the breakout level to see if this was really the breakout level or not, and then jump from here again. So that slow unwinding that we are seeing on the McClellan oscillator, on the overbought MACDs, RSI coming down, all the stuff that I showed you in the past 20 minutes, it could be that the market basically is losing energy. And yes, it's going to trade between a channel of 100, 150 points, maybe hits to 2400 again, like I explained. And who knows, we might overshoot and go to 2450, but I'll just leave that for now. And then slowly peter down and then come down to and test the 2300. This I consider to be a major buying opportunity. So looking at this chart here, this consolidation bull flag is actually quite intact, but it is not a bull flag unless we break out over 2376. And I hope all of you can see that. Try to zoom in as much as possible without losing sight of the picture. Right there. If we break out over, let's say, 2376, that's when you call a consolidation channel breakout. Change the color again. To me, this comes naturally, but you guys know exactly what I'm talking about. Okay, there you go. Okay, so there. That. Going into this channel, is it possible we get another monster move which takes us up there? Absolutely. Generally speaking, consolidation channel bull flags don't break down because there's major uptrend line support here. You see that big fat blue line? But any break below that opens up the pathway to 2300 real fast. And that's only 50 points. And 50 is not it's a 300-point move, but still, individual stocks get hit a lot harder, right? We talk about 100 points on the Dow, 200 points here and there, but when we're trading, those things can mean a lot to individual stocks because they can be down much bigger. You all know that. So this bull flag is still intact. High probability that it breaks out and goes towards 2400. We retest it. Any failure would bring us down again to test this uptrend line. Any break of the uptrend line below the 2350 or level, that means we're coming down. So to a lot of the new members who have come in, let me explain one thing to you very simply. If you do not understand the background, the kabuki theater, the stage where all your stocks are trading on, you're going to get blasted out of this market faster than anything else. I'm a pro trader and I still have a tough time navigating volatility. And the reason I understand what you all go through is because we're all in the same boat. So if somebody like me who understands the market to a very high degree can still have difficulty sometimes managing specific trades, then where would a trader or a clueless member be if they don't understand the basics of the SPX and the E-minis? It's really as simple as that. So you have to have a working knowledge of what I'm putting through, because you could have a fantastic trade going. All of a sudden, sell program comes in, the pattern breaks on the E-minis. I'm posting it out there. You think the trade's going to go higher? No. They're just going to dump it, because day trading hedge funds and their machines who are day trading the market, up 5, down 6, up 10, down 5, price line, nobody wants to buy it. I'm showing that it's a buy. It's up $17 from when I showed it. It's all day trading. Did anything change in price line? Yeah, somebody might say the drop in oil helps price line. Big deal. This oil's dropped before. Price line hasn't moved. It's all technical. It's all tactical stuff. So bottom line is that that you guys have to, keep an eye on these things. This is a very clean chart. High probability it breaks out towards here. Towards the 2400 level again. Low probability that it breaks below this. And we have to watch this carefully. Now, the other positive thing that's going on here, this is the dynamic momentum index. It's basically a function of all the, what do you call, momentum indicators, is we're starting to see this. That's a positive sign. That means that the market still has room to move. Now, this fills in with my theory that they're going to end March on a very strong note. But they're going to shake up things around the middle of the month for a day or two, or maybe a day or three. Okay, so bottom line is that this slow moving turn on the 4-hour is telling us that maybe the market is starting to bottom, but we don't have a full scale crossover yet. Let's take a look at the daily. The daily, and here is what I really wanted to show. So please, everyone just listen to it. That's it. You just have to listen to it. Let me do all the hard work of showing this stuff. Consolidation bull flag. Looks nice, like a little Lego picture, right? There is another gap here. And that gap is right there. It's a minor gap, but it's somewhere, well, that's the gap that it never really filled. The lower end of the gap it didn't fill, 23.48. This gap is there. There is another gap here. And all gaps get filled, by the way, one with the other, upside and downside. If you notice on the daily, it's very clear it is far from bottomed. And this is the daily. So this is where mixed signals come in. So we have to keep our trade sizes smaller. Don't go over lopsided on one thing or another. Don't get overexcited. Don't get depressed. Just deal with these things as I keep on showing it so you can act on it. Because this is telling you from a swing perspective that the market is still coming down. Once it starts doing this, these are huge buy opportunities. Like this. That was obviously November elections. You see that clearly. This is still pointing down. Maybe that's why those other mixed indicators that I showed you are still pointing down. And that's the slow stow. Now, is it possible the slow stow just comes down here and then turns from here? Sure it can. Anything can. But I'm just showing you that these are the very optimal times. Once it goes below the 20 mark is when you want to dig in real hard and sit there for a week or two on some swing trades. But it's not there yet. Once it gets there, who knows? Maybe it gets there when it gets down towards 23.25, maybe these levels. That's when it's doing this crossover, like here. Last thing I want to show you guys is the upper end of this massive channel, 2457, is still valid. But crossing channels doesn't happen in one day. It happens over multiple days or even weeks, and then it just, it starts to move over into a different. Remember, we were trading, and this is another thing to keep in mind. We were trading, this was the acceleration phase since November. This is a clean chart. So we bumped up 1, 2, 3, and then we kind of moved sideways right after the elections. But we're in the upper channel. Let me call it channel 1, channel 2. So we're in the upper channel. So we stayed within the upper channel till we broke into the lower channel. And that was back in January. We broke into the lower channel and we still kept on climbing. But remember, we are still in channel 2. Channel 1 is this zone here. And channel 1 is where you get the most power. So are we losing power a little bit? Yeah, I think so. It's the topping process, as I said. So does everyone get that? This, right after the election, we jettisoned ourselves from channel 1 to channel 2. Sorry, channel 2 to channel 1. The lower channel I'm calling 2. And we are still in that lower channel, despite the fact that we are higher. So I'll take a question or two. I'm certainly here to answer any question or two, and then we're going to wrap up, because I just want to cover these quick basic things. Yeah, go ahead.
Hey Frank, I got a question.
Yeah.
Isn't there one more lever that's sort of happening? Was the bond yields going up, which causing problems there too?
The bond yields going up is it's a two-edged sword, right? Thanks for bringing this up. So basically, let's take a look at the weekly here. Weekly, it's a large cup and handle, invert head and shoulders, but it's more like a cup. Let's just do it as a cup. Hold on. It's like that CMG cup and handle that I showed. Okay, there's your handle. And now it's breaking out over the handle. So what's happening is you are seeing a significant, when bond yields are going higher, I'm going to call yield. They call it bond yield, basically interest rates on bonds. Rates on bonds, they call it yields, are going higher. The price of that bond is going lower. So the bottom line is that there is a lot of pressure there too on the price side, like Corey correctly pointed out, where just like a bond, I mean, it's an asset, right? Just like a stock, you're losing money because the price of your bond is falling and the yields are rapidly rising because the Fed is ready, and we get a strong numbers report. It's 100% that they're going to raise rates. I think the market's already built that in. So in a way, it's good and bad, because first of all, when prices are dropping of bonds, money's flowing out of the bond market and they're finding a home in the stock market. Maybe that's the reason why these techs stayed green all day. Biotechs did very well, and other things were mixed. So there is a positive outcome to that. The negative outcome is that when prices are dropping on a certain asset, there are margin calls. So like Corey correctly pointed out, you got oil on one side, you got hedge funds getting blasted, and then you got these huge amounts of bond funds where the prices are dropping rapidly of their net asset value of their portfolios, and they also get margin calls. So there are two things going on. Now, the other thing I want, that is not necessarily positive, because when they are losing money, then hedge funds, let's say, who own a lot of fixed income bonds, they also have stocks. They got to sell the stocks to come up with the money to pay for those margin sellouts or the margin calls on those particular fixed income side of their book. Again, we never know what the exact numbers are. I know a lot of hedge funds were more heavily exposed to long oil than long bonds, right? So more mutual funds are exposed to long bonds, a lot of fixed income funds. How much hedge funds? I don't think so. I think they're more into the oil part, so that carries more weight on the sell-off side. Another thing to keep in mind, that if bond yields at this point climb past the 2.8 mark, you will see fear. I mean, you will see a negative effect on the overall stock market. Like Jeff Gundlach said, and I'll tweet out the article today, and he's the bond king, and he is the best. He makes PIMCO's Bill Gross look like baby food. Jeff Gundlach is smart. I don't think he knows much, he's really that good about stock market forecasting, but bond forecasting, he's brilliant. So Jeff Gundlach, like he said, as we head close to 3%, expect some real jitters in the market. That means that the dividend yield on the S&P 500, which is roughly around 2.6% right now, that's the dividend yield, average dividend yield you get from owning dividend yielding stocks in the S&P 500 and the Dow Jones. You are getting competition from it, from a no risk asset, which is going to pay you 2.6%. So a lot of big money says, I can get 2.6% on my money with literally no risk if I hold it for the duration of the thing, because these are government bonds, right? There is no risk of default. Then why should I get 2.6% from the stock market, which carries a lot more risk? So you start getting competition from the bond market for owning stock. So there's a lot of asset allocators, as they like to call them, who basically shift to the bond side for the safety and earning 2.6%. And if it keeps on going to 3%, believe me, it's, high interest rates have a lot of negative effects aside from having positive effects. Banks have positive effects on high interest rates. The net interest income goes higher. The servicing revenues, all that kind of stuff. But a lot of other costs go up. Loans, mortgages, car loans, credit card loans. So, it has an effect. So you don't want it to move above 3%. That wouldn't be too good. It's not the end of the world. It's historically very low. So that's, so that's there. Okay. In, do you have any quick questions?
No, I'm okay. Thank you.
Did you understand some of the concepts we talked about today?
Yes, yes.
Okay. So all I'm saying is we get a lot of terrific tactical trades, but they move so fast, so quick that at this juncture in the market, what can I say? It's tough to make a strong case that it's a one-way street up or a one-way street down. And I want everyone to fully understand that, because, and the final thing I'll show you is this is a weekly chart of that same. This is a weekly chart of that same. 1 second, please. Chart, S&P chart that we saw on the daily, and I just want to make this very clear. On the weekly chart, this was Brexit, June 27th. See, we made that nice move, came down. See the difference? This was Brexit. This is Brexit on steroids. This is the Trump victory, the new elections, and this is what happened. On the weekly, the lower end of the channel is 2345. So we are still within an uptrend channel. There's no question about it. But we could get another week of a downtrend, and that could pull us down. Like I said, not much. Not much, but these are the levels I watch very carefully, because once these levels break, all of a sudden you're looking at a minor trend change. And is it possible, some of the strategists have talked about, that we can go down to 2250? Even one of the best analysts out there, market analyst Katie Stockton of BTIG, talked about it this morning, that we could get a couple of weeks of a sharp pullback. Absolutely. Absolutely. They're not to be feared. They're to be welcomed, but we do not want to be positioned long when those pullbacks happen. That's just the way it is. And it's hard to determine when and exactly how those pullbacks start. But one quick thing would be tax season coming in April, end of the first quarter. End of the first quarter, generally, things start to pull back and all that kind of stuff. And there we are with that box. This was a breakout. Oops, sorry. That's it. So another thing is, a lot of good trades are being posted there. Some very powerful winners across the board. Take little bits of pieces. You don't have to go overboard. Don't try to make that home run every single time, because then it's just not going to work, because these machines are nuts. And I've always been a straight shooter, always be a straight shooter. These aren't, believe me, unless you're positioned right on these tactical lows that I showed, like yesterday, 2 days ago, and stuff like that, when it feels really crappy to buy, but things are really oversold and stuff like that, those are good times to buy and sell the next day. Today, this morning, with this things just running higher and higher and higher on the individual stocks, multiple individual stocks that we made money on, the Regenerons, the Amazons, the Pricelines, and a bunch of others, CMG. It's called shooting fish in the barrel, where you're positioned right and then you're just taking profits. And you see it run up a little bit more. I sold Amazon, it ran up another $2. So what? You already make some decent money. But don't chase things too hard. Don't rely on the goodness of the market, because the market is not a good place. These machines are designed to steal your money, and you see that every single day. So with that note, I'll see you guys tomorrow morning. I'll be up early, and thank you for attending the webinar. See you guys first thing in the morning.
Thank you.
Thank you.
Have a great evening.